Good morning. Welcome to Market Monday. This is our final reminder that tax returns are due or must be postmarked by tomorrow, April 18th. All right. Well, last week we got the March CPI inflation data, and would you believe it's trending lower? In fact, here's a look at the last 10 annualized inflation readings. You could call this a linear trend, month after month, a little lower than the month before, and not one time higher than the prior month. Of course, the most recent reading annualizing under 5%.
But still a little high, no? Definitely looks to have peaked, which we've been talking about ad nauseum for over a year now, but still stubbornly high. So what gives? For starters, airfare's screaming higher at almost 20% year over year. Motor vehicle maintenance and repair over 10%. But look at what's down. Gasoline and fuel down 15% or more.
Staying here for another minute, here's headline CPI here in gold, and look at what's higher, meaning causing a higher inflation number. These rascals right here, rents, and this darn owner's equivalent rent. Shelter is about 40% of the total CPI report, so a huge weighting. And owner's equivalent rent is about 34% of total CPI. Yes, that survey, which asks homeowners what their home would rent for, is still driving inflation higher. Here it is, look at that, 8% year over year.
But haven't we seen plenty of data that suggests rent growth has peaked, along with a modest decrease in home prices? Here's how shelter is actually contributing to CPI. Rents either peaking or just about there. This orange is owner's equivalent rent. So let's take this same shelter CPI and look at it over here in green. Same data. You see the green bars getting bigger. Can you imagine if that was flat? In the real world, it basically is.
And not only that, egg prices are getting fried, poached, and scrambled with a month-over-month drop of 10.9%, the largest drop since 1987. What else? It's getting really expensive to buy cars, especially new cars. Not only are prices still high, higher than average inflation, but the average interest rate on a 48-month new car loan in the US has moved up to just under 7.5%, the highest since 2007. A year ago, that rate was 4.87%.
And today, we'll wrap with a reminder that when you see headlines about declining earnings and various forms of doom and gloom, remember when earnings are extremely high, above 20% year over year, the annualized gain for the S&P 500 US stock market was just 1.9%. When earnings were very bad, say down 20% or more, there was a sizable negative annualized return of almost negative 10%. But perhaps counterintuitively, when earnings were between negative 20 and positive 5%, that environment created the highest annualized stock market returns.
Indeed, investing is not linear, nor is it logical. It's why we have to approach investing with humility, respect, and understand that short-term pain is a feature of investing, a toll of sorts, to achieve the long-term gains. This clearly shows often when it feels the best time to invest is not the best time. And when it feels bad, could actually produce the best future returns. Thanks for watching. Have a great week.